According to recent data from WealthX, 67.7% of the world's ultra-wealthy population are entirely self-made. They did not inherit their money, and they didn't win the lottery. They reached a high net worth by executing a specific, repeatable mathematical system. We will look at exactly how they do it by building your own automated wealth engine. To build this machine today, you only need three things: a steady source of income, your recent bank statements, and the baseline discipline to live on slightly less than you earn. Transitioning from wishing you had money to actually accumulating it requires abandoning emotion. It is simply a matter of predictable, mechanical execution. Step 1 is millionaire math. Creating wealth relies on an equation with three absolute variables: time, discipline, and money. This chart shows the exact monthly investment required to reach $1 million by age 65. If you start at age 20, the math requires you to invest just over $100 a month. If you wait until you are 40, that requirement jumps to roughly $1,000 a month. Time and capital have an inverse relationship. The older you are when you start, the more cash you have to aggressively inject into the system to compensate for the loss of compounding time. Step 2 is creating the margin. Whatever your monthly target is based on your age, you have to extract that exact amount from your current cash flow. We isolate this capital using the 50-30-20 framework. You allocate 50% of your after-tax income to unavoidable needs, like rent and groceries. 30% goes to lifestyle wants. You then strictly wall off the remaining 20% for wealth building. To hit that ratio, you will need to evaluate your spending and reduce your current service levels. If your required millionaire math exceeds that 20% margin, you have two choices: aggressively cut your subscriptions and lifestyle costs, or immediately find a way to increase your income shovel. Without a mathematically enforced 20% margin, your wealth engine is starved of fuel. Reaching $1 million becomes statistically impossible. Step 3 is building your break glass foundation. Attempting to invest before you complete this step is financially reckless. Calculate 3 to 6 months of your basic living expenses. You must route this exact amount away from your checking account and park it in a dedicated high-yield savings account. Without this cash cushion, a critical car repair or a sudden medical bill will shatter your financial progress. When an unexpected expense hits, an empty savings account forces you into toxic credit card debt, or worse, forces you to prematurely liquidate your stock assets at a steep loss. This fund is not an investment vehicle meant to generate high returns. It is the engine's armor. Its sole purpose is to protect your compounding math from real-world chaos. Step 4 is automating the wealth engine using a method called dollar cost averaging. You set up your brokerage account to automatically pull your exact target margin from your checking account. Schedule this transfer for the day after your paycheck hits, so you never even see the money. Route those funds to purchase broad market passive ETFs. Avoid the temptation to pick single stocks. The historical failure rate for individual stock picking is exceptionally high. Passive ETFs dramatically lower your management fees, diffuse your risk across hundreds of companies simultaneously, and consistently outperform active trading over long time horizons. This graph shows how dollar cost averaging protects you from yourself. During a market crash, human psychology will scream at you to stop your automated transfers. Step 5 is hold and scale. Because your system is automated, market downturns act as a mathematical advantage, buying assets on sale. When you zoom out, those terrifying short-term dips shrink into a dominant, long-term upward trend. Automation removes human emotion from the equation. It transforms a volatile stock market into a relentless, mechanical share accumulation machine. You have now constructed the entire wealth engine, a budget that guarantees a 20% margin, a cash cushion to deflect emergencies, and an automated transfer consistently acquiring broad market ETFs. There is one final silent threat to your engine's survival: lifestyle creep. As you earn promotions, raises, or bonuses, you must apply the rule for scaling. That new money must be routed to increase your automated transfer amount. It does not go toward upgrading your car or renting a more expensive apartment. True wealth building is not glamorous or exciting. In fact, it is deliberately boring, automatic, and highly methodical. The math cannot begin to compound until you manually switch the engine on. Log into your banking app right now and schedule your first automated transfer.